Okay, picking up where we left off on page 587, we're talking about net present value. So I've got this loan for $40,000, but I don't need it all at once. I want to take $20,000 out the first year because I need to spend a lot of money there, and let's say $14,000 the year after that, and maybe $12,000 a year after that. So it's the payments essentially. The money being extracted from this investment is not uniform. So instead of using present value, I have to use the net present value guy. Okay, so here we go. So this would be net present value. Okay, so the rate is going to be, let's just use the same old, 6%. Now this time I don't have to divide by 12 because I'm assuming that we're talking about annual things. I'm pulling $20,000 out the first year. Okay, so I don't have to divide by 12. And then this range of values. Now you don't select the first one. You just select only the payment parts. Okay, so if I made 3 payments, I would select those 3 guys. Okay, but we're not done because if the net present value is only going to give me the calculations on that part. If I want to see the big picture, I have to add back in the original value. Okay, and I know that sounds a little weird. Okay, so here one more time. Actually, let me just go ahead and hit the button first. All right, so let's go here and look at this one more time. Gee, thank you. That's not what I wanted. Huh, okay, fine. What I was after is the rate, which in this case is just the 6%, and then the range of values, and then I have to add back in. And notice this does have to be negative, okay? And these do have to be positive. From a point of view of again, you accounting folks are going to nod your head going, yeah, that makes sense. You know, for the rest of it, it's like, okay, whatever, it has to be negative. I guess I'll go along with that. Alrighty, so the 6%, and so same concept as present value, except if the terms are not. Now there's one more called irregular net present value. So what if you have an investment where you're taking money out in an irregular manner, and the timing is also irregular? So let's do $40,000. And so let's say I got this guy on the 1st of January, and then I want to take payments out. I want to take, I don't know, $8,000 out on, I don't know, the 2nd of March. Maybe $12,000 out, I don't know, the 15th of June. I guess I should make all these the same year, huh? And let's do one more. I'm going to take, I don't know, $20,000 out on, I don't know, for September 15. Okay, so now, not only are the payments irregular, but the timing in the payments are different. So to calculate the net present value now, we have to use extended or irregular. X for extended, I would still say irregular. So irregular net present value. The annual percentage rate, because, you know, since the period of time is different, you have to just use the annual one because there's no other benchmark involved. And now the values, and this time it's going to be, you do include the initial negative number guy. So you grab that guy for the range of values, and you grab this guy for the range of dates, and you end up with whatever the net present value is on an object that both the payments are irregular and the timing is irregular. Okay. Let's kind of change topics a little bit, and let's talk about, okay, how do I compare two investments, for example? Here's an investment I have. Let me go ahead and make this a number. Actually, since I didn't fill too many of them, and this is going to be kind of dumb, but I need a quick and dirty way of comparing investments. And so there's a way, it's called an internal rate of return. And it's a very cool little tool. And all it basically does is look at something and say, yeah, that looks good. And because if you're not an accountant, you'd be kind of hard pressed to say, you know, is this good or is this bad? All right. So this is the internal rate of return. And basically all you have to do is grab these guys. Now this is an odd one, in that you do grab the original guy and all the payments. So before you didn't, okay? So this gives me a nominal 8%. I'm gonna increase the. Okay, let's go do this one with the same thing. So IRR. Of course, this was a stupid example, but that's beside the point. Well, dang it. I'm going to have to do an XIRR, aren't I, to make this make sense. I tell you what, I'm not going to bother. All right. I don't want to get in too much in the mechanics of this stuff because, again, if I was going to use one of these financial functions, I'm going to look it up. I am not going to commit this to memory. I'm going to go say, wait a minute now, how's this work one more time? So all I really want you to know is when to use stuff, right? So when would you use an internal rate of return or an irregular internal rate of return? Well, so when you can evaluate investments, okay? I have 5 options to choose from. What's a cool way, a quick and easy way for me to look at them and go, yeah, okay, that one's better than that one. Well, the internal rate of return or the irregular internal rate of return is a cool way of doing it. I'm going to skip kind of sort of some of this other stuff. We're going to talk about it. On page 594, they talk about straight line depreciation. And it's pretty simple stuff. You know, if I have a piece of equipment, okay, mine is. I have a piece of equipment, and it costs something. It has a so it costs $40,000. I like my $40,000. It has a salvage of I don't know, $8,000. That's how much it's worth at the end of its life. And how long is it going to live? What's its life in years? Say it's worth 5 years. Okay, so. From an accounting point of view, I want to know how to depreciate that using straight line. So straight line depreciation would be straight line. So what's the cost? Ding! What's the salvage? Ding! What's the life? Ding! It's going to tell you that you ought to depreciate this at $6,400 a year. Now, some pieces of equipment deteriorate fairly nicely. Others, you know, the depreciation is very high at the beginning. So there's another way you can do this. There's another one called declining balance. And I'm not going to go into when you should use one type of depreciation over another. That's an accounting kind of question, not an Excel question. So just kind of nod your head going, okay. So my declining balance, whoops, DB, is basically the same thing. What's the cost? Ding. What's the salvage? What's the life? Ding. And what's the period of time that we're talking about in years? So let's say I'm at year 2. Okay. Let's do another one. So the other one is double declining balance. And this is designed for things that, you know, half its value and half its value and half its value kind of a thing. So one more time. DDB. And it's the cost. And it's the salvage. And it's the life. And we'll do, what did I use before? 4? I don't remember what I used. 2. Okay, let's use 2. And you can see that, you know, it depreciates faster in the other technique. So again, let's kind of review because I don't want to get you too into the weeds on this stuff. I'm never going to ask you, for example, on a test question, you know, what does, you know, present value mean in this scenario? That's an accounting question. This is an Excel class. What I'm going to ask you is when to use which one. So, for example, I'm trying to find out how much money I'm going to have at the end of my my savings account. What would you use? I'm trying to evaluate a bond. Which would you use? I'm trying to evaluate multiple investments. Which would you use? I'm trying to figure out an amortization table. Which would you use? I'm trying to figure out how much interest I paid in the first year of a loan. Which would you use? Those are the kind of questions I'm going to be asking you. I'm going to be asking you, given this scenario, which of these following financial functions are you actually going to use? I'm probably not going to get into the weeds on. I will get into the weeds on the minus things. Like, okay, this has to have a minus here. It doesn't work. That's a good one to know. You know, that kinds of things. Like the issue here, where there's two different techniques for doing this. I can calculate using the cumulative, or I can calculate just with the payment on the principal and just the principal guy. Those are good questions. Okay, we have reached the end of this guy, and see you guys again in some future chapter.